I have done kind of a research on the industry, the European film industry market, trying to know what problems do they have
Right.
and what are the challenges ahead of them, but
Okay.
not much detail.
Right. Okay. That's good. Keep on doing that one and start reading the pre-scene as much as possible, because
Mm-hmm.
every time you read pre-scene, you might get something new which you did not
Okay.
got it earlier, which you have got it now. So
Right.
I have already started work on the pre-scene. I have already
Mm-hmm.
done one or two mocks on the pre-scene.
Okay.
So I have done. So we can. What I'm going to do is after today, I will send you one of the 45-minute mocks. As you know, there will be four sections, four 45-minute sections in this case
Mm-hmm.
study. Each will be
Okay.
45 minutes. Once the first section is over, only you will see the second section. But normally
Right.
they are interconnected. If it is something with the launch of a particular film, the second section also will be with that one. That's the kind of a
Mhm.
thing. So one thing what we need to know is whatever we write in the first section, we should not contradict in the second section,
Right.
because
Okay.
it's a
Yeah.
flow, right? It is you're working in one company. So one day you will
Mm-hmm.
have one problem with a particular project. Second day you will have
Mm-hmm.
another problem with the same project, but you can't contradict whatever you said in the first area.
Right.
Right?
Okay.
So you have to keep that one in mind, because it's not like just doing an exam. It is a case study.
Mm-hmm.
So that's
Right.
one thing. So what I'm going to do is after today's meeting, I'm going to send you
Mm-hmm.
a mock which I have developed. I'm just developing some mocks now. I'll send you
Mm-hmm.
for you to just to go through, not to answer,
Mm-hmm.
but just to go through to put up your points in bullet form or whatever, so that when we meet next time, we will discuss that one.
Okay. No problem.
Right? So that's one thing. Then coming back to the pre-scene, it will be officially
Mm-hmm.
out, I think, say
On
somewhere this,
Friday.
yeah, and that's correct. 16th it will be out officially, but
Yeah.
I'm more than 100% sure it will be the same case study that you will be getting in.
Okay.
Right? So that's all right. I have already done the financials, a
Mm-hmm.
bit of analysis on the financials, which I will share with you. I've taken the cost
Right.
structure. I've taken the cost breakdown, and also worked
Mm-hmm.
out certain ratios arising from these
Right.
things, so that it will help us. The idea is not to memorize, but to have some idea. Now, for example, we can see in this particular thing, the direct operating expenses about 54% of your revenue.
Mm-hmm.
So we know
Right.
roughly, we don't need to know it is 54, but we know more than 50%, roughly about 55% is on operating expenses. On marketing, we spend about 25%, something like that.
Right. Okay.
So I
Yeah.
have done that analysis for you. I will share this one also when we are doing the financial analysis.
Mm-hmm.
So these are some of the things already I have worked out on this case study. So what you will do is you will look at all those industry analysis to see what problems they face. And in the
Mm-hmm.
film industry, as I said, it's every film is a project. Every film
Yeah.
is a project, and in a project, the three things: one is the cost. You have to keep the cost according to your budget as much as possible. You must
Right.
deliver it on time. Project management is
Mm-hmm.
also about delivering it on time, because already you have
Right.
advance booked the film halls, so you have to
Mm-hmm.
deliver the film by that time. And the third
Mm-hmm.
one, the quality also matters a lot, because
Right. Right.
ultimately we
Yeah.
are selling it to a public audience. It's an international film, and something
Mm-hmm.
which I did, which I realized was box office revenue. I took it from the pre-sale. Uh, from
Mm-hmm.
your own country, B land, we get about 38%, but from other countries we get about 62%.
Right. Okay.
So
Yeah.
this we did it for a typical film that 1 weekend in Moscow or something, but that may
Mm-hmm.
be the trend. So bulk of our revenue comes from selling the film to other lands, foreign lands.
Yeah.
So of course, when you
Right.
sell it to the foreign lands, we have to understand we will have certain foreign exchange risk, political risk, and also being a
Mm-hmm.
film, the cultural risk also.
Right. Okay.
Because the film is produced in a European country, but sometimes when the film goes to another country like Asia or any other country, it may have to be modified according to the Asian culture. Some of the films of the Western culture may not suit the local culture. But we can
Okay.
see
Yeah.
bulk of the revenues, 60% of the revenue roughly comes from the screen in the film abroad.
Okay.
So probably that will tell us in our board of directors or in our finance, we need to have good corporate treasurer who knows about these foreign exchange dealings, because there will be a lot of dealings on the foreign exchange in this category.
Right.
Right? So these are some other things. So we will go on discussing. So as I said, more you do the reading, you will get more
Mm-hmm.
issues coming out on the surface. So this is why I say always keep the pre as much as possible.
Okay. Right.
So one thing what I realized after the last session,
Mm-hmm.
normally what I've seen always, you are the finance manager, true enough, but generally you are the finance manager looking after the managerial accounting aspects. Normally in the
Okay.
management case. But here they don't say anything about the managerial case study, about the managerial. So you're basically a finance manager. Finance manager essentially is the person who will be in charge of preparation of financial statements and about managing the finance. Generally, in
Right. Yeah.
almost in all the other places we have seen, specifically they say you are involved in costing, management accounting, that area, providing information on the management side of it, all that. But here
Mm-hmm.
they have not said anything like that.
Right.
So why I saw that one was, I just quickly go to the, you remember they say they are adopting, they are listed in the stock exchange and they are adopting
Mm-hmm.
IFRS, International Financial Reporting Standards, right?
Right. Right.
Now, what I saw was just look at your financials.
Mm-hmm.
Financials, the extracts of the maintenance annual report. One
Mm-hmm.
thing we have to remember now, you are going to sit the exam in February 2017. So the financials are as at 31st December 2016.
Right.
Right? So that's the very latest that what we have. Just about 1.5 months, or just little shorter than 2 months away from your exam, the financial statements are prepared. So very
Right.
unlikely these financial statements are audited.
Okay.
Right? Very unlikely these financial statements are audited. So I was looking at this presentation of the financial statements, right?
Mm-hmm.
Because they say they are going along with the IFRS 2. But if you look at this financial statement presentation, you can see the way they have presented does not comply with the IAS 1, where they say the starting point is revenue, cost of sales, gross
Right.
profit,
Yeah.
establishment expenses, administration expenses, operating profit margin, all that kind of a thing. But you can see
Right.
here, this particular statement, it does not fall in line with those compliances.
Okay. Yeah.
So this may be some area which you may have to comment it. So I see lot of F2 stuff in this question. At least in one of the
Okay.
variants, you will have lot of F2 stuff about the presentation of financial statements.
Mm-hmm. Okay.
Because normally what we see is we have we don't show depreciation and amortization separately. It is part of your operating expenses. right? And first what we see is we have the revenue, then we have the cost of production or cost of sales or whatever, and then
Mm-hmm.
later on we have the gross profit. From the gross profit, distribution and marketing, and then administration. Depreciation and
Right.
amortization is never shown, and you can see it's a very small figure compared to the figure, so it's not a material figure. So this is not the IFRS format to prepare the financial statement.
Right.
So something which we have to, so I would urge you to go through your earlier things and to find and to look at the IAS 1, how to the format for the preparation of the financial statement or the presentation. Because you being the
Mm-hmm.
finance manager, you are responsible for the particular IFRS presentation. Because if you prepare like this, they may not accept or adopt the accounts.
Right. Okay.
Then another thing what I realized, if you look at the statement of financial position, again you can see you have non-current assets, which is perfectly all right, right? But when it comes to the other side of it, we don't have current liabilities shown separately.
Right. Yeah.
Right? So this statement is surely not in compliance with the IFRS. Because we
Right.
must show the current assets and current liabilities separately, where we can even work out the ratio. So
Mm-hmm.
they have shown loans, and then they have shown payables, and then they have shown film obligations and production loans.
Right.
So there is something in that one. And if you look at, we will certainly look at the financials, but you can see one thing I want you to note out is it's a consolidated statement of financial position. Consolidated
Mm-hmm.
means the parent and the subsidiary companies are consolidated.
Right.
So it's not a single entity account. It's a consolidated financial statement. So you have to remember, according to IFRS 10, just note down, you can just Google and find out IFRS 10 and IFRS
Right.
3. Just go to that one to see what are the requirements of consolidation. Just to refresh your memory on your F2 area, when you prepare
Mm-hmm.
consolidated financial statements, all intercompany balances are eliminated.
Right.
Right? So when they say receivables, when they say payables, it's only outside third-party figures are involved. None of the intercompany things are involved in it. Right? So
Right.
that is
Right.
what the consolidation means. And you can see if you really go into this little bit of details, this one last time, this is about how they arrange the corporate structure for a film. So this is for this one weekend in Moscow, right? The
Mm-hmm.
parent company is the main team, and always they
Mm-hmm.
will, for each project, each film, they will have a company called OWM Finance or whatever the film name, a company called Finance. That company
Right.
is the real owner of the film.
Okay.
Own other field. So 60% of, in this particular case, 60% of the money came from the parent company and a 40%
Mm-hmm.
came from an outsider. So you can see
Okay.
always there's an outsider involved in this preparation of the film.
Right.
Right? So the Mentine is the parent company and this OWM Finance, which is a subsidiary of Mentine, is owned
Mm-hmm.
60% by the parent, 40% by some outsiders whom we call non-controlling interest.
Right. Yeah.
Understand? Non-controlling. So if there is non-controlling interest, in our financials, in the statement of financial position, we must have an item called non-controlling interest.
Yes. Yeah.
Understand? Right? But
Mm-hmm.
in our statement of financial position, what is there, we don't have anything
Don't
called
have nothing.
non-controlling interest.
Right.
So probably I think the financial statements are not properly presented.
Right.
So that is why I think they have put this time finance manager without saying that you are responsible for management accounting, because even this may, because you can see a very complicated structure for this film company, they may be looking at you and asking you, one of the directors might attend one of these so-called conferences or all that, and say and come and say, Veena, we should have non-controlling interest. Where is non-controlling interest?
Right.
And you may have to explain according to IFRS 10, IFRS 3, all that, because we can see a goodwill. If there's a goodwill happening, that means we have acquired some other companies. And it is
Right.
told that some certain other studios we have acquired. So when we acquired, if we have acquired 100%, of course, there is no non-controlling interest. But if you have acquired part of it, there will be a non-controlling interest.
Right. Yeah.
However, in the film industry, for each film, the finance is one of the big problems, and they said it's a big risk. So they will be looking for external financials. So because this they say studios often seek external finance in order to significant costs associated. This is often achieved through creation of companies that are established for a specific project. For example, the production one weekend in Moscow was organized as follows. So we have the parent company. They put 60%.
Right.
The external investor put 40% in this particular film. The ratios can vary, but one thing you will realize is the major controlling interest will be with us, and we will have a third party investor.
Right.
And that company is called OWM Finance, and that company will finance the project for a company called OWM Production. For each film, there will be a financing company. Each film, there will be a production company.
Right. Okay.
Understand? Right? So the financing company will finance. How will they get the finance? Parent company will give big amount. A third party investor will give some amount, and all that money will go to produce the film.
Right.
And finally, once the film is produced, the film is given to the finance company. The owner of the film is, you can see the arrow coming towards the completed film. They finance it, and the ultimate end product, the film, is given to the finance company.
Right. Okay.
And the finance company sells that, or the finance company signs an agreement with another company called distribution. Now you must understand the distribution company is not film specific. It is for all the films.
Okay. Yeah.
OWM production, OWM finance, but Mentee distribution is not OWM. It is the company that is distributing all the films produced by Mentee.
Right. Yeah.
Understand? So yeah, it's a very complicated structure, but if you really simply learn it, you will not have too many difficulties trying to get into that area. Right? So
Okay.
there is this distribution company which may be distributing all the films produced by, so OWM production will produce one film, another name maybe Hatari or something will be another film, right? So there will be many films that is being produced by many production companies, and all those films will be distributed through the maintained distribution.
Right. Okay. Yeah.
So each finance company will sign a distribution agreement, and finally, once the distribution is done, the proceeds belongs to the parent, to the finance
Fine.
company. Finance company.
Right.
So
Yeah.
the finance
Right.
company will declare dividends, and that dividends will go to the parent company, and part of the dividends will go to the third party shareholder.
Okay. Yeah.
That's the structure. Right? So that's the structure. So we have to be well aware. So we know there has to be some non-controlling interest. But in our financials, we did not see that non-controlling interest. So maybe in one of the variants, they might put up a question on that.
Right. Yeah.
This is slightly different pre-seen, what I've seen from all what I've seen. It has some complications, it has some implications more on the financial accounting than on the management accounting. Because most of the time it has been almost management accounting, but I can see something on the financial accounting here.
Right.
So you remember the board of directors? Here we have the Stephen uh, from 1994. The chief executive has been chief executive since 2013. Is a financial specialist who previously worked for a major hedge fund. So a fairly long outstanding employee and who has taken over as the CEO about 3 years back.
Okay. Yeah.
Then we have the finance director who is just about 2 years, professionally qualified accountant. Her previous experience included several years with the television industry. So she also seems to be right for this board of directors because she has this television films. I mean, they go in the one family. So it's like that. And then
Mm-hmm.
distributor, director distribution since 2009. He joined Maintain from a major competitor. So
Right.
the three executive directors we see here all seem to be having right kind of a attribute to be a director.
Mm-hmm.
Then we
Okay.
have Lavasani, qualified lawyer who has been a director of Maintain since 2007. Right, so I think that is also a very important position because we have to sign lot of contracts with these actors and kind of a lot of legal contracts with this film industry. So you need to have a good legal position in the board of directors.
Right. Yeah.
Then we have Eugene has joined the board this year while has enjoyed a highly successful career in the film industry and well known and respected social script writer. So probably the one, two, three, four, five people in the board of directors in the executive category, right, seem to be people with diversity, with interest.
Right. Yeah.
One thing probably what I did not see is they don't have a kind of an international director or person with international exposure because
Mm-hmm.
60% of their revenue is coming from the international arena. So I suppose if we were asked about to recommend a recomposition of the board, I would have included a person with international knowledge into the
Mm-hmm.
board.
Right.
So then we have non-executive directors. Remember, this is a
Mm-hmm.
listed company. So listed company has to fall in line with good corporate governance, but it's not a
Mm-hmm.
UK company. UK, it says the majority should be non-executive directors in the board.
Okay. Yeah.
But not being a UK company, it's no compulsion that the majority should be executive director, non-executive directors. But generally, for good corporate governance, it's good to have more non-executive directors than the executive directors. That will give
Right.
the non-executive director the challenge to challenge the strategy of the executive director. So we have Alex, a Mentis chairman since 2009, well known in the industry for his innovative work with computer-generated imaging. So I think a very useful person because we know computer-generated imaging is part of the film special effects. So we need some person who knows about it. So I think Alex is a very useful one, and he's the chairman. Nimrod is a
Right.
non-executive since 2014. He runs a charitable arts foundation. So probably again something to do with the industry. So he is all right. Leonard joined members both this year as a non-executive following retirement from partnership in a lady law firm. So they have another a kind of a legal side support coming from a non-executive director. Then Howell is a non-executive since 2012. He had a successful career as a film director and joined Maintain's board after retiring from filmmaking. So
Right.
board seem to be a very balanced board, except they don't have
Mm-hmm.
an international director and probably distribution we have one person, director of distribution. So I think it's the board looks all right.
Right. Okay.
Right? So coming back to the financial statements here, we can see the revenue. So what I did was I did a little bit of an analysis.
Mm-hmm.
remember that they gave a typical cost of that 1 week in Moscow. So there
Yeah.
are two main costs. One is the production cost of a film. Second one is the marketing cost of a film. So for this
Right.
film, they gave 264 million as the production cost, 180 million as the marketing cost.
Right.
What I did was I took the total cost as 264 plus 180, 444, and what I see is about 5940. So shall we say 60-40 is the ratio.
Okay.
60% of the total cost is for production, 40% of total cost is for marketing.
Right.
So that's a very important one. So we know marketing is a very, very important aspect in the film industry. 40% of our cost is on the marketing, right? So maybe in the marketing, we may have to outsource certain things. We may have to have our own marketing people. Now, one thing what you would realize in this thing, we have a distribution person, but we don't have in the board a marketing person.
Right. Yeah.
Isn't it? We are spending 40%, but we don't have a person in the board about the marketing. So probably some area we may have to think if you are going to re-strengthen the board or to reconstitute the board, we might want to think of marketing also as a
Okay.
key critical success factor.
Right.
40% of cost is on the marketing. Right? So this is why they are given the pre-scene much earlier for us to analyze this one. And after the 264 million cost of that particular film, what I did was I went through the cost to see the cost structure. Story writer, they pay 30 million. Screenplay, they pay 15 million. All that I analyzed it. And what I say is on the special effects, they are having a 30% expenditure.
Okay.
Special effects. So remember what is special effects is all that, compute imagery, the sound effects, all that what they put after the film is produced, post-production. This is what we call the special effects. So the bulk of the amount is on the special effects.
Okay. Yeah.
And production, the studio expenses is about 23%. So 55% of your expenses are that one. And then the actors, they spend about 15%. So the three big items, special effects, production, and actors. And you can see very little that you can do with those costs. And if you really look at the producer and director, the costs are not too heavy, 6%, 5%, but they are very critical. So I don't think you will ever recommend them to reduce the producer's cost or director's cost. If you are thinking of costing, saving of cost, you remember the Michael Porter's analysis, they say to get an advantage, one thing is cost leadership, other one is product differentiation.
Yeah. Product differentiation.
Product
Yeah.
differentiation. So probably here we can see they may be able to reduce certain costs, but surely the cost is not the thing. I think the whole thing will depend on producing a kind of a different film, which will have an impact upon the market. Right?
Okay. Yeah.
And also, from the pre-scene, what I found was out of the actors 40 million, the main actor and the co-actor gets 30 million, 22 million and 8 million or something. 30 million.
Okay.
Right? That was I got it from your pre-scene. So 75% of your actors' fees goes to the two main roles.
Okay. Yeah.
Two main roles. So that is also very important. So that really shows how important for us to get the right actor, right co-actor.
Okay. Yeah.
The success will depend on that one. Then the marketing cost is 180 million, and after marketing cost, given us the breakdown for this film, 72 million is spent on TV advertisements.
Okay.
So 40% of your advertising is on TV, right? And then there's about newspaper about 18%. So they are the big items, and then also cinema trailers about 15%.
Right. Yeah.
So that's also very important information for us to know how the cost structure is made up. And then looking at the revenue, total box office revenue, 1,337 million of that film, right? 40%, roughly about 38% comes from the home country, 60% comes from the outside.
Okay.
Now a very important one. Look at the revenue figure 1,337, right? Look at your 2016 revenue, your income statement and profit or loss statement. Profit or loss, we have 2,611 million revenue. Total
Right.
revenue for 2016. Total revenue for 2015 is also 2,804 million.
Right. Yeah.
Right? So there's a slight drop in revenue from 2611, from 2804 to 2611. Fairly a big amount, 193 million difference, but I think 7% I worked it out below. But one thing what you will realize is it's about 2 films for the year. 1,337 is one film, the collections, the box office collections, that is without the videos and the DVDs and all the other things. So they probably are focusing, concentrating about 2 films for a year.
Okay.
The total annual revenue, 2,611. Typical one box set should bring about 1,300. So it's about 2 films that they are doing.
Okay.
So one thing that probably you may want to look at is whether there's a possibility of increasing the number of films from 2 to 3, maybe. Because some of the expenses will be very fixed. That is why they are given a depreciation and all that. Some of the expenses will be very fixed. So if we can do another one film for a year and increase the revenue, you will have variable expenses, but usually because you can see 444 is the total expenses, 1,337 is the income.
Okay.
Yeah. So there's a big income coming up.
Right. Okay.
There's a big income coming up. But if you really look at on the direct operating expenses, there's 1,417. Distribution and marketing, 644. Now I'm a little bit confused, right? On marketing, they say on average film they are spending 180 million.
Okay.
180 million, right? So if they are making 2 films, it should be about 360 average.
Right.
But they are spending 644 million, but 180 is only for marketing. So the balance may be for distribution.
Yeah.
Distribution, because distribution cost is not included in the marketing cost. So there will be 3 costs: production, marketing, distribution. Production, marketing, and distribution. So operating expenses will be the production plus whatever the other cost. But we can see this administration expenses 236 million. Last year it was 241 million. Now administration expenses mostly it will be fixed.
Yeah.
Mostly it will be fixed. The direct operating expenses and distribution and marketing, that is 79%, say roughly about 80% of your revenue will be somewhat variable. Will be variable, right? So if they can produce one more film, I suppose they can get another 20% increase in their contribution.
Right.
So way for them to increase profitability will be not to go down on the cost line, maybe to increase and to see whether they can produce a 3rd film for the year. If they can put up 3 films on the board, because they are not restricted on the marketing side of it, because they are not only selling it local, they are selling it abroad, foreign. So in the foreign countries, there are many film halls. So they are not restricted in that area. In our country like Sri Lanka, we have a problem because our films are of not that quality. where we can market it abroad, right? So we have to market it locally. So here we have a problem. We don't have many cinema halls which can cater. So because of that, we have to produce a film and wait in the queue. But
Okay.
if you
Yeah.
are producing quality films which can go to the international market, the market will not be restricted for you. So
Right.
here they can, if you are thinking in terms of, so this will be one of the variants surely, to improve the profitability, you have to think of producing a third film, a third box office hit film in a year.
Okay.
But I'm still thinking, because the 1,337 is only the box office revenue. Box office revenue means only on the cinemas, right? So in
Yeah.
addition to this, they will get something from the DVDs and something from the merchandising. So if you take all that, even they may not be producing, they may be not showing even 2 films for a year. Even it may be less than that one.
Right.
If
But
it is,
Kumar,
yeah.
does it also include the income from subsidiary?
This is
If
consolidated. This is because it is consolidated. It will
Mhm.
include the income from subsidiaries, but all outside income, no intercompany.
Yeah, no intercompany income, but
Yeah,
all outside income has to be included in it.
included. Yes, yes. There
Yeah.
won't
Okay.
be,
Okay.
because now when the production company sells to the distribution company, there will be some intercompany profits, but all that will be eliminated. So
Eliminated. Yeah. Yeah.
this
Yeah.
is pure profit, pure revenue, what they have got from outside.
Okay.
All
Right.
intercompany things will be eliminated because since they are preparing consolidate.
Right. Yeah.
Right? So this 1,337, they say it's the according to the precinct, it's a box office revenue. But you remember they said in addition to the box office revenue, they will have some other revenue coming from DVDs and merchandising and etc. It may not be
Right.
a big amount, but still there may be certain amount. So if we take that figure also, 2006, if we divide it by 2,611, maybe it's less than 2.
Yeah.
Maybe. So I think the area for them to improve is to see whether they can squeeze in another one film, because about 80% of the expenditure is direct, but a 20% contribution can come because the administration expenses will not vary.
Right.
This is why they
Yeah.
gave the figure. Depreciation and amortization also will not vary, right? Will not vary. So we can increase the operating profit if we can do another one film. Then the other thing is the
Right.
finance cost. It has come down from 48 to 14, from 48 to 40. Then
Mm-hmm.
profit before tax is 266. Last year it was 341. Right? So a
Right.
slight drop in revenue has caused a fairly a big drop in our profit from 389 to
Right.
306, from 341 to 266, and the profit after tax from 305 to 232, a big drop.
Yes.
Right? So this may be a worrying factor for a company that is a listed company. Profit coming down
Mm-hmm.
is not something that will be good for the share prices. So this may be a worrying factor for any one of us.
Mm-hmm.
And you can see what are their non-current assets. Their non-current assets are films. So I don't know how
Right.
they classified it as a non-current asset. Anything that is classified as a non-current asset is something uh, which is not expected to be disposed.
Okay.
Right? So films cannot be a non-current asset in my view. So what I want is I want you to go into this European film industry, look at a company and see how they classify the films in their balance sheet. I did not have time to go through, but I will do that one.
Mm-hmm.
You also better look at their financial statements and see how they classify it, because normally when you say non-current asset, it is this property, plant and equipment which are meant to be kept.
Mm-hmm.
Films cannot be kept. They have to be sold out. So film, I think, should be a current asset mostly.
Right.
Hmm. Mostly the film should be a current asset because films are there to be sold out. right? You might be selling the film to another company, whatever, and that's how the films are being produced and sold out. So films cannot be a non-current asset, but it can be something, the older films can be, but I think this presentation is something which is causing big problems. We must go to into one of those companies and see how they produce the balance sheet, but I'm sure not, it cannot be a non-current asset.
Right.
There are very little property, plant and equipment, slightly it has gone up. It is acceptable because, films are basically, it's lot of human intellectual capital and efforts that is going. So there is very little property, plant, maybe a few cameras, that kind of a thing only they will require.
Right. Okay.
Yeah. Then the goodwill, we can see it has not changed from last year to this year. So probably according to IFRS 10, goodwill need to be checked for any impairment. And if there's any impairment, it should be impaired immediately, right? So
Right.
we do not know whether they have reviewed it for impairment. If they have reviewed and if there is no impairment, then no problem, it should be treated. But one thing it really shows, unless it's a very compensating thing, no acquisitions have happened during the year. Because if there are
Yeah.
any acquisitions happening, the goodwill should go up. So most likely no acquisitions have happened during the year. That is why the goodwill remains same 330.
Right.
Then we have the current assets, the receivables. So receivables are basically nothing to do with intercompany since it is consolidated. So the receivables must be what we have to get from outsiders. So what we have to get from outsiders is from the film halls for screening the film. They will collect money and a certain percentage of that money should come to us. And that's our revenue.
Right.
That's our revenue. So sometimes we will sell the film outright to the film halls, or sometimes we might go on a percentage. I think here it was going on a collection basis. So one thing, good internal audit will be needed because they will have to audit all the cinema halls to see that they properly give their collections, whatever the percentage, to us.
Okay. Yeah.
Right? So that's what the receivables are. Then bank, we can see last year they have at 94 million. This year also they have about 98 million. And one thing that shows when you compare with the film in the magnitude of 444 million to be produced, we seem to be having a little bit of problems with our cash.
Okay.
We have a lot of money in the receivables, but that is always in the receivables. So we might fall into few liquidity problems if we go on like this. So only way I think we have done is no change. It is 800 million. Retained earnings have gone up. Obviously, we will expect it to go up because of the profit they made during the year, right? Loans 340, 350. So loans have gone up slightly. Payables have gone up slightly. So payables may be that what they had to pay for these actors and that kind of people. Film loans and obligations 584 to 620. Deferred revenue 263 to 278. So one thing you realize, the loans have slightly gone up. 340 to 350, 584 to 620. But our interest cost has come down.
Right.
From 48 came down to 40.
Yeah.
So how come when the loans have gone up, interest cost has come down? Now that may be something which you want to think about it. Loans have gone up, interest have come down.
Okay.
One possible reason what I can think of is the interest rates may have come down in the country.
Yeah.
In the country.
Right.
That may be because maybe inflation has come down and that may be the reason why even the revenue has dropped. That could be a possible explanation. Now these are some of the things they might ask you. They might ask, some person might ask, "Well, how come that our interest rates have, our loans have gone up, but the rates have come down?" Another reason what I can think of is, because what we see the year-end figures, maybe they have taken loans towards the end of the year, right? Towards the end of the year, they did not have it for the entire 365 days. And so that may be a reason why the interests have come down.
Right. Yeah.
Yeah. So possibly, so you have to think like that. You have to think many things that can happen, because this is why this analysis is very, very important for all of us. We can get lots of items from this one.
Yeah.
So then what I did was I worked out some of the ratios like return on capital employed. So I want you to remember what is return on capital employed. It's profit before interest and tax divided by capital employed, in this case total assets. Profit before interest
Right.
and tax divided by total assets. So total assets came to 2759. Profit before interest and taxes came to what we call the operating profit,
Yeah.
came to 306. 306 divided by 2759 gives us an 11% return. So what is return on capital employed? For every dollar that, for every $100 that you invest in the business, we get an $11 return.
Right. Yeah.
Last year it was 15%.
Okay. Yeah.
Last year it was 15%. So that means there is a slight drop in our return on capital employed, which will be a worrying factor. Not a very big return what we are getting, but that return is also coming down.
Yes.
Then I worked out what we call a dividend payment. What I did was I took the retained earnings at the beginning, which is 297.
Mm-hmm.
Which is 297.
Mm-hmm.
Then I took the profit after tax what they earned for the year. Profit earned after tax for the year 232. Right? So 297 was your opening retained earnings. During the year they have earned another 232. So 529 altogether. Now the closing retained earnings are 400.
Right.
Closing retained earnings are 400. So when I deduct that one, I get my retained
120.
earnings as one. I get my dividend payment as 129.
Right.
So that's also a very important one, because what we realize is we have paid a dividend which is 129. After paying a dividend of 129 only, we have a 98 million balance in the bank account.
Yeah.
So if we are in a little bit of a crisis, we may be able to defer a dividend later on if it is necessary. Remember, dividend is something which we need to pay to keep the share prices, without any disruption.
Right. Yeah.
So then I looked at the operating margin. Operating margin is the profit before interest and tax divided by revenue, right? Divided by revenue. So profit before interest and tax was 306.
Yeah.
Revenue was 2,611. So
Yeah.
306 divided by 2,611 gave me the what we call operating margin. Right? So operating margin is
Right.
12%. In other words, to earn $100, or to earn revenue of $100, we spend $88 on expenses. That is what it means. To earn
Right.
$100, we spend $88 and we keep a $12. Last year, to earn $100, we spent only 86. So there's a slight increase in the cost also comparatively.
Mm-hmm.
The other one what I worked out is the asset turnover. So this one, Return on capital is 11%. Return on capital divided by operating margin is what we call asset turnover. Asset turnover is 0.95. In other words, we turn assets only 0.95 times, not
Yeah.
even once a year. We turn over the assets. So asset utilization seems to be very poor in this particular scenario. That is because we have a big asset called films. We have to see what it is. They are not given any explanation. We have to see what is these films in this pre-scene scenario.
Right.
Finally, what I worked out was the receivable days. Receivable days, that I worked it out, taking closing receivables divided by revenue multiplied by 365 days, because our revenue is split for 365 days. I want to see my closing receivables which are outstanding, how many days of revenue is outstanding. So 2611 is my revenue. Right? 2611 is my revenue. So when I take that 2611 against my receivables 874, what I see is about 122 days it takes us to collect the money on average on a film.
Right.
122 days, right? So it takes about 4 months to collect. Last year it had been about 113 days. This year it has taken 122 days. So that is the money that we have tied up, our money tied up in the cinema halls or whatever.
Yeah.
So this is what I got from my financial analysis. We'll study more and more because I'm just getting into the figures. And these are the figures what I have just already collected from the basin, which I will share with you all.
Right.
Then looking at the financials, the risk analysis. Now this is very important because they have suggested certain risk analysis carries out business in various countries, resulting in exposure to movements in foreign currency. When translated into B dollars, we use forward contracts to hedge this risk. Right. So what they are saying is they to manage the forward the exchange risk, they are using forward contracts. So we have to understand in the forward contracts there can be upside risk, downside risk both. So if at the time of conversion, if the exchange rate has moved in your favor, still you have to enforce or you have to go by the contractual forward rate, and you might end up with losses in that scenario. Maintained interest expenses exposed to movements in interest rates. We do not hedge this rate. So last year we see interest rates either have come down or whatever it may be, but there is a risk always, but they don't hedge it. So maybe something we may have to think of about interest rate exposure, how to hedge it. There's a risk that with the closure of cinemas due to the popularity of downloading films, people are waiting for DVDs or downloads to become available. Films will lose money at the box office. Now that's a big threat. That's a big threat because the people don't want to go and watch a film in a film hall nowadays. People are willing to wait for the DVDs or to download it through one of these websites and to watch the film at home rather than going and watching a film in the cinema.
Right.
So most of this, unless it's a super. So this is why the special effects becomes very important. Right? Because we can watch a film at home, but we don't get that same feeling, same sounds in our TV.
Yeah.
So because of that, the way to now, if you look at the foreign exchange, usually they are managing it through the forward exchange, which is all right. But we might want to think about looking at options as an option because forward exchange rate is a good thing, but we can't manage the upside risk. We can't take advantage of any upside risk with the forward exchange. Interest rate
Right.
risk is something which may want to manage it because it's a risk that is always there because we are looking for big finance and film takes a long time to produce. So today we will do the net present value analysis, but by the time we take the loan and do the film, it can take long time, and during that time many things can happen. So therefore, to cover the interest rate, I think it's a good thing to go for interest rate hedging. Business risk,
Right.
the way to go forward is to have films which will be, people will be forced to go, or people will want to go and see it in the cinema with good sound effects, good special effects, rather than watching it at home. So this is why today most of these films are 3D films, 4D films, which we cannot enjoy it at home. So that's the way the film industry is getting differentiated.
Right. Yeah.
They did not say anything about the 3D films and 4D films, but I believe it will be something in the unseen because I think the films that the big companies are producing today will be all 3D and 4D films.
Yeah.
It will becoming harder to get external funding to make new films. It may result in us being unable to make so many films every year. Now, this may be one factor they are having even at the moment. They are only producing and selling 2 films for a year. Right? So
Okay.
finances may be one of the problems. So maybe one way out is to go for a public share issue, a rights issue, because they are a listed company, and to raise more money so that they can, without depending on a third party investment, they can make their own investment.
Right. Yeah.
Factoring is also another possibility because they have a fair amount of receivables. If they can factor and get that money, that may be very helpful for them in the finance.
Okay. Yeah.
Overrunning is a major risk as most are behind schedule. Costs are considerable when films overrun. That is, if you don't produce a film according to the delivery dates, it can be a very, very costly one. So to have
Right.
good project management, good steering committee, and good post-completion audit to see where we went wrong, what went wrong are the things that need to be looked at.
Yeah.
They are given all these risks for us to analyze the risk and to find out what are the mitigating factors we need to do to take care of each of the risks. Share move in reaction to box office figures. If our box office tickets fall, so does our share price. So probably last year, the share prices may have come down or will come down once the accounts are published. So far, maybe accounts are not yet published. You have to remember because we are in February. The financials ended up 31st December. Once the financials are announced, if it's a semi-strong market, the share prices may drop.
Yeah.
So we have to be conscious of that fact, and we may want to make a proper communication. The way to go forward is to tell about our future plans. If you have a good
Yeah.
plan for the future, maybe we can cover it up. You remember in the pre-scene they said about some films they were producing. Producing special effect, for example, a crowd scene that would have required. For example, the following special effect will be budgeted for films that Maintain is about to put into production. So they have about a couple of films already lined up. Kindness of Trash Train, Liner Rescue, Poverty Row, and Special Disaster.
Right.
So there are 4 films that is going into production. So they can talk about some of these things that is going to come up, and they must give that confidence to the shareholders that even though there is a drop, the things will pick up with these new films that is going to come.
Right.
So this will be part of your strategy on the people skills to make announcements to the market about the new films that are already coming up.
Yeah.
So that's basically all. Then we have the SWOT analysis. The leading management consultancy. So some third party has done a kind of a SWOT analysis for the company. So their
Mhm.
strengths, very recognized brand, professional
Right.
and artistic experience, ownership of a valuable film library, appealing to a variety of demography. Now that is something I want to check that one. I think the non-current assets are the films what they have, maybe the films what they have already produced, which is there with them, right, which has a value variety of demographic library appealing to a
Mhm.
variety. A good relationship with key professionals such as writers and directors, good relationship with leading actors, good distribution network.
Right.
So they are their strength. Weaknesses, difficulty in selecting which films are made. So they might go and do a wrong film which is not what the crowd want. Limited internal funding for new major films, right? So this is
Mhm.
why I said there is a possible public listing coming up on this question. Right? They may
Right.
want to raise the equity base because they have a amount of loans. They may want to raise the equity base because they need to have their own internal funding rather than depending on the external funding. Significant number of
Yeah.
films in progress overrun, which is very costly. Significant number of films in progress. So that means proper project management is not happening and that is going to make cost more bigger. Difficulty in tracking cost, this is common to all film companies, right? So
Right.
not having a proper budget, not being able to do it. So I think a good IT system to capture information may be the solution.
Yeah.
They might think of introducing a good IT system to capture all the information so that they can track costs because they are working on many films at this one and at the same time. So it will be very, very difficult for them to do the tracking of
Right.
growing market for cinema attendance, right? Growing
Mhm.
market for alternative methods of product delivery such as downloads, major growth potential in overseas markets. Threats,
Right.
illegal film, illegal downloading, unpredictable
Yeah.
audience numbers, improvements in home cinema technology with this home cinema, high sound effects and all that, people may not want to go for the cinema. Difficulty in predicting success on new film means high risk of expensive commercial failures, limited backers available for major new films, high marketing spend by competitors, that's a very important one. So that means there's a lot of
Mhm.
competition. If we don't market our film, others may catch up. And
Yeah.
audiences migrating to lower cost options such as watching films online. Yeah. So all these things can have an impact upon the film industry. In fact, if you really look at overall, I think the film industry is down. People don't go too much for films unless it's a very, very super film. So
Yeah.
the strategy is not cost reduction, but to produce
Mhm.
something totally different where the people will go for it.
Yeah.
So Beeline cinema attendance content, this is a press coverage, some in January 2017. So it's
Mhm.
recent. Going to the cinema was the main form of entertainment 30s and 40s. Few other forms of information, no internet, no television. Few people had cars, many could walk to a local cinema. As people began to have televisions in 1960s, cinema attendance started to fall sharply. They could watch films, other programs at home without the cost of a cinema ticket. Then in 70s, the growth video rental saw cinema attendance fall further to a lower point in the 80s. Renting a film on video was much cheaper than visiting the cinema. It appeared at this point this would thrive and traditional cinemas all but die out. Unexpectedly,
Mhm.
the opposite has happened. Cinema attendance has recovered and the video rental market fallen as people can now download films from the internet. Although visiting the cinema costs more than downloading a film to watch at home, and evening at cinema is cheaper than many other forms of entertainment such as live theater or concerts. Visiting the cinema can provide a welcome break from emails, other interruptions. such as 3D screens means now the 3D screen is mentioned here, but never in the pre-scene in the other part. So I can see 3D, 4D coming up very big way.
Right.
The overall movie market has increased with DVD sales and online film downloads increasing more rapidly than cinema attendance. So you can see
Attendance.
the
Yeah.
new trend in the market is for DVD sales and online film downloads.
Yeah.
Cinema people go, it has caught up, but the new market is that one. So we should be thinking in terms of online website being open. This has been a famous question in the exam all the time. The online website being open, a project of an online website where the people can download the film
Yeah.
directly, right? So you have to have security measures like having the people will they give their credit card and all that kind of a thing. So we have to have all the security measures to get the film done to allow the people to download. So that may be a new strategy which you may want to work it out.
Yeah.
So that's
Right.
great. So I think we are now finished up the pre-scene. So you're going to read the pre-scene all the time. You can see if you look at the Finland cinema revenues, it's going up. 2003
Right.
came down a little bit, but it is going up, and you can see it's still on the rise. At least up to 2015, it is on the rise, right? So you
Right.
just go on reading up. I must read in. I'm still trying to pick up few things, but I have already, as I said, I started my mocks also. So I will send you a mock for you to just to go through. But more than the mock, try to read the pre-scene. Try to catch up few things all whatever we have.
Right. Yeah. Okay.
So next week we can start on our mocks now.
Okay. Right.
When is your day free,
Uh,
Veena?
any Saturday, Sunday again.
Yeah, Saturday, Sunday.
Like in the morning hours is fine with me.
Okay. So 17th Saturday, I'm all right. I can do it even morning, Saturday.
Right. So what time in the morning?
Saturday, we have a 10 o'clock.
10 or
Today,
11.
yeah, today we did it on Sunday, no? How
Yes.
is Sunday or Saturday? What is more convenient for you?
Anything.
Saturday, Sunday, shall we do it Sunday? Because Saturday I have a class, 2-hour class from 10 to 2 or 12. So we can
Okay.
do it on Sunday same time. I can do it like today.
Like 10 o'clock in the
10
morning, yeah?
o'clock, yeah, 10 o'clock, 11 o'clock, I'm free tomorrow, Saturday, Sunday.
Next Saturday. Oh, no, on Sunday, yeah?
Sunday,
Right.
yeah.
Fine. Fine.
Shall we make it
Fine.
10 o'clock?
Yes, 10 o'clock in the morning, Sunday. Next Sunday is fine with me as
Okay,
well.
so that is 18th. We will make it. Before
Yeah.
that, I send you the mock also for you to go through. And from now onwards, we will be looking at mocks.
Okay. Right. Kumar, I just
Yeah.
want to have a question.
Yeah,
That
sure.
last time we left it on page number 5, it said like which had a description of the key roles in filmmaking.
Uh-huh.
So I mean we have not covered it. So is it like
Alright.
we have to go? Yeah.
Right, okay. What we will do is, you remind me next time, I will note it down now. We will
Right.
start it from that one and we will take about 10-15 minutes and cover up that area also. Sure. You start reading.
Yeah.
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 You start reading because we will, I have not noted down, but I will note it down now. And you start reading, but we will cover it up that area, don't worry.
Yeah. Okay. Fine. So it's just that I just want to make it remind that we have less like 3-4 pages. Obviously.
Okay. Sure. We will do that one. Don't worry. Yeah, because
No problem.
this area is very important because they are in a guild and all that kind of thing. So we must do that one. So let's start it from that one when we make next time.
Sure. No problem then. Yeah.
Okay, thanks, Veena. Have a great day.
Thank you, Kumar. You too. Take care.
Teacher.
Have a nice day.
Bye.
Bye.
Bye.